please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. You're watching Power Breakfast on CNBC-TV18. Well, back home on Dalal Street, it was yet another day of declines where the market saw a sharp fall in the last hour of trade. Now, the Nifty breached the 11,300 mark, while the Sensex tanked nearly 300 points. Broader markets, especially the banking index, took a sharp hit after the government's merger announcement. The PSU banking index closed around 5% lower. The mid-cap index also failed to hold on to the 19,000 mark. But that was about yesterday. To tell us the cues and the trade setup for the day, Sonia joins us early this morning. Sonia, well, the global markets ended in the green, but crude and rupee continue to worry.
Oh, that's the reason why our markets were under pressure yesterday as well. As you mentioned, second day running, the markets closed in the red. In fact, now the Sensex is down 800 points just in the last 2 days. There was quite a bit of selling that we saw from FIIs as well. 1,144 crores is the kind of selling we saw from the FIIs in the cash market. And, even if you look at the data coming in, not looking good, rupee continues to hit record lows. Brent crude has surged above $79 a barrel. In fact, the Saudi Arabia officials said that they're comfortable with higher crude prices. That's what got crude spiraling. But on the other hand, there's also a risk of the global crude supply escalating, and that could put, that could cause crude prices to move up higher. Data is expected to reveal a fifth straight decline in US inventories, and that really could cause crude to move up further. Apart from that, you look at the US 10-year Treasury yield as well. It's risen sharply. It's hit the highest level since May, now trading at 3.05%. And if you look at the week so far, the Nifty and the mid-cap index are both down about 2% for this week. So not been a good week for the bulls at all. In fact, it's not been good for India compared to other emerging markets. So in September so far, the MSCI India index is down about 6.2%. In comparison to that, MSCI Asia ex Japan is down just 3.2%, while the MSCI Emerging Market Index is down 2.9%. So there's definitely a big degree of underperformance that India is seeing compared to the other emerging markets. The positives, however, one, as you mentioned, the US markets ended in the green. The Dow was up about 200 odd points or so. And the other is that SEBI released that revised circular on the KYC norms for FPI. So it's a big relief for those foreign investors that were impacted by these rules. A couple of positives, but the overall trend still remains on the downside.
Okay, all right, Sonia, thanks so much for trade setup. But tell us, what are the stocks you're looking at in today's trading session?
Well, SEBI yesterday changed the total expense ratio for mutual funds. So these AMC companies, the listed ones, could be in focus today. MCX could also be in focus. SEBI has said that they've taken the first step to open commodity derivatives markets to foreign investors. So let's see how MCX reacts. Sun Pharma has announced that it has received the European Commission's approval for an antibody drug by Almirall. The rollout of this product will start in Europe over the next few weeks. It's used to basically treat psoriasis. So, keep an eye out on Sun Pharma. Positive development there. ICICI Prudential Life Insurance has signed a bank assurance partnership with the Saraswat Cooperative Bank. ICICI Bank has clarified that they have not filed any application for the settlement, but only a response to the show cause notice has been submitted to SEBI. This is in reference to, the SEBI chairman Ajay Tyagi stating that ICICI Bank had filed a consent petition with SEBI regarding that Videocon group dealings. So ICICI Bank has clarified on that. Rights will be in focus. Rights Limited, they've received an additional turnkey contract worth about 436 crores from the Indian Railways. This contract is in addition to the existing project for setting up a wagon workshop at Dalmia Nagar, and the initial contract cost was about 90 crores. Now this additional contract cost is 436 crores. Some smaller stocks in focus. KIOCL, the board has approved a buyback of 1.26 crore shares at a price of 170 rupees. IL&FS Transportations, Moradabad Bareilly Expressway Limited has received a compensation claim of around 425 crores from the NHAI for some losses that they suffered. So, that could be in focus. And the IRCON IPO was subscribed about 1.02 times on the second day. Remember, all PSUs are in focus after that big merger that took place. So there could be lack of interest with this IPO as well. Some insider trades. The Apollo Tyres promoter group PTL Enterprises acquired about 1 lakh shares on the 14th of September. Back to you.
Okay, Sonia, thank you so much for that. But as you mentioned, in terms of the macro cues, rupee at 733 level continues to be a worry. And in a bid to stem the rupee fall and curb a widening CAD, the government is readying a list of items for import duty hike. We'll get you more details on that after this short break.
Well, let's get straight to a CNBC-TV18 exclusive then. The government is readying a list of items for import duty hike. This in a bid to stem the fall in the rupee and keep the current account deficit under controllable levels. However, we learn that CBIC, or the Central Board of Indirect Taxes and Customs, is not in favor of import duty hike on gold, steel as well as coal. Timsi Jaipuria joins us with all those details. Timsi, over to you.
That's right. As the government battles out tough economic situation of reducing the burden of current account deficit by imposing import curbs, sources indicate that CBIC is not in favor of import duty hike on coal, steel and gold. On the other hand, the Revenue Department has cautioned against any import duty hike on goods that may hit the ongoing flagship programs such as Make in India and Digital India. Thus, the Finance Ministry has now asked the key economic ministries to identify which goods can be put forward for possible import curbs. Some of the mechanisms which are under consideration of this include non-tariff barriers, minimum import price and import duty hike. Sources also added that the Revenue Department will be able to finalize the list of goods only after it receives inputs from line ministries, post which a formal nod will be taken from Finance Minister and the PMO, which could be only by this Friday. Also talking to CNBC-TV18, government officials added that this final list will be prepared considering the impact on domestic industry. An important observation being that any hike of levies on gold would lead to more smuggling. Similarly, hike in duties on coal would have an adverse impact on power plants. Thus, officials say that import duty hike will be considered only on specified commodities for a limited period of time, only with one goal of keeping current account deficit under control. Government is also not in favor of import duty hike on imports for cell phones, as it feels that this could go against Make in India and Digital India programs. Even Telecom Ministry and MeitY have expressed their concerns against this proposal. All in, we will now need to wait and watch to see which are the goods that make into the final list of possible import curbs. We'll keep you posted on it.
Okay, Timsi, thank you so much for that. We trust you to get us the latest on that. But not just import curbs, sources tell us that the government is working on a package to incentivize exports as well. So we're given to understand that the centre may extend the interest subvention scheme to merchant exporters. That's not all. The merchandise exports from India scheme, under which the government provides duty benefits, may see inclusion of more sectors. Moreover, the centre may expand guarantee via Export Credit Guarantee Corporation for restricted countries like Syria and Libya as well. Well, we spoke to former chairman of CBEC, Najib Shah, on what he makes of the import and export picture. Hear out what he had to say.
There are huge challenges in this, and obviously the line ministries will have to advise the CBIC as to which are the items they would like the CBIC to impose taxes on, and only then it should go forward. The long-term repercussions are going to be immense, so we need to strike the right balance. So I think anything between 6 months to 1 year, we are now looking at the uppermost. Beyond that, I don't think we should be really looking at any of these. And in case they kick in, they should have an impact in the next month or two itself, these measures. Exports ultimately are not so much about the incentives you can give from here, as much as the markets which are available in the world economy as such. And we need to make our goods competitive, because price is a very important factor for these exports to enter those markets. So I think all the export promotion schemes are already in place. They are, in my opinion, fairly generous. There is drawback. There is the scheme for merchant exports. There is a scheme for services exports. They are giving substantial amount of money. What we should ensure is that money reaches the exporters without any loss of time. And another issue which constantly comes to them is interest subvention. So that is something which the government can look at.
Well, as the government is mulling import curbs, Sanjeev Sanyal, the principal economic advisor, cautions against the adverse impact of such measures on economic growth, as well as stressed on the need for export shops as well. In a conversation with Lata Venkatesh, he also talks about the weakening rupee. Let's hear out that conversation.
We will look at, including, if necessary, tariffs and other steps are being considered. But as I said, it will be done with a medium term in view. For the immediate concerns, the main thing remains that the Reserve Bank, which has more than adequate reserves, will continue to use its reserves to manage volatility. And I think a point that I made earlier and many times is that people get too excited about the bilateral exchange rate between the rupee and the dollar. The fact of the matter is the rupee, if you take a 5-year perspective of the exchange rates, has been broadly stable against virtually every exchange rate other than the dollar. So there was no particular reason for us to have heroically stood out while all our competitors and trading partners had depreciated. So an adjustment did happen. But let me also say that, as things stand, the rupee at current exchange rate and with government bonds at a little over 8%, I would argue that these Indian government securities are very, very attractive by global standards as a asset. So, do not think that this is a one-way street.
How many $1 billion is the government targeting to save by imposing duties on imports?
No, I don't think that is how you do it, because the danger in that is that in order to hit some sort of a target like this, you will force fit all kinds of barriers, tariff or non-tariff, and will end up eventually hurting the economy in some fashion. So you have to be very, very careful when doing these things, not the least because many of these items are inputs into things that are, our own industry and our competitiveness, number one. Number two, there are also WTO and other agreements, trade agreements on which we have signed up. So we have to be very careful that we do not sort of abrogate these international commitments. So given all of these things have to be done very, very carefully.
Well, what about export growth in that case? Should we expect some packages for some sectors?
Certainly, export promotion remains something we are keen on. But as I said, while packages can be put in place, they do take a little bit of time for response. So as far as the current exchange rate issue is concerned, that will continue to be driven both partly by international developments and partly by views on the stability of the Indian economy, which I think is in good nick. The Reserve Bank, when it feels like using some of its reserves to control volatility and these kinds of factors. The longer term export competitiveness of the economy, of course, will have it takes some time for these things to feed through.
Has the government done any study about what's hurting our exports?
Look at the very latest numbers, you'll see a very sharp increase in exports in the recent months. The issue is that we also are seeing very sharp increase in imports because the economy is accelerating, oil prices are high and so on. So while there may have been some time ago, problem with export growth, that is not the issue. The problem is overall trade is actually booming if you look at the recent numbers in dollar terms, not just in rupee terms. So if I can't remember the exact number of the latest month, but it was something in the range of 17% exports and 19% imports, something like that. I forget the exact number, but they were very high.
Yeah.
Trade goes up and down.
Yep.
Indian exports are now, and remember, are now growing. And remember that these exports are happening on orders given at a completely different exchange rate. So the impact of the current decline in exchange rate, should there be one, will happen in the subsequent quarters. So it takes some time for these things feed through to the real economy. But it isn't the case that the Indian exporter is now not participating in global expansion. The problem is that our own very strong growth and very importantly oil prices has meant that imports have also grown very, very quickly. And hence the review that we said on this, even this discussion on essential, non-essential that is happening is being driven by this observation.
Okay, on that note, let's slip into a quick break. Up next, SEBI makes a U-turn on the April circular, which barred NRIs from being beneficial owners of FPI funds. Detail of crucial decisions taken at the board meet yesterday when we return. Welcome back. You're watching Power Breakfast on CNBC-TV18. Well, market regulator SEBI has made a U-turn on the April circular, which barred NRIs from being beneficial owners of FPI funds. Now, after calling the concerns regarding the KYC norms preposterous initially, the market regulator has now said that a revised circular will be issued soon. Now, what led to this change in stance by the regulator? Hear out what SEBI Chief Ajay Tyagi had to say.
There was one confusion which actually broadly I must say and admit that it was that for beneficial ownership under PMLA there is a definition of beneficial ownership. That was clarified by Department of Revenue when it came to our notice. Our suo moto we gave it to Khan Committee. No one has asked us to give it to the Khan Committee. We took up with Department of Revenue as to what is their view. And then they clarified that PMLA definition is for KYC purpose, for reporting purpose. And as far as the eligibility is concerned regulator could take a view. So that's how it started. There was no intention of not having consultation.
Well, SEBI Chairman Ajay Tyagi also said that ICICI Bank and Chanda Kochar have expressed intention to settle the case over alleged irregularities in loans given to the Videocon Group. ICICI Bank responded saying it has replied to SEBI's show cause notice, but it has not filed any application for settlement. Yash Jain is here with more details on that. Yash, what did SEBI chairman say about this particular case?
Well, it all started in the question and answer session which happened post the SEBI press conference, where journalists asked SEBI chairman Ajay Tyagi on whether or not Chanda Kochar as well as ICICI Bank have filed any sort of settlement or a consent application in the ICICI Bank Videocon loan case. At that point of time, SEBI chairman Ajay Tyagi referred this particular question to the whole-time member at SEBI, that is Ananta Barua, and he at that point of time clarified that a settlement or a consent application has been filed by both the parties, that is ICICI Bank as well as Chanda Kochar. But later on, after that session, when journalists reached out to him to seek more clarity in terms of the road ahead for the settlement application, he clarified that no formal settlement or a consent application has been filed with SEBI so far, but yes, an intention from ICICI Bank as well as Chanda Kochar has been expressed when it comes to filing this settlement application. Nevertheless, one needs to understand that a settlement application essentially means that any individual or a company or an institution wants to settle any particular default without accepting or denying any sort of wrongdoing. And yes, from that perspective, just the intention of filing a settlement application from both ICICI Bank and Chanda Kochar does narrate a very, very crucial story.
Thank you, Yash, for that. But another important decision from the SEBI board meet. Now, in line with the stated intent of the government and RBI, the market regulator took a step to deepen and expand bond markets. Now, according to SEBI's directive, companies that have over AA rating and want to borrow more than 100 crore rupees should raise 25% of the requirement via bonds. Now, the order takes effect from 1st of April. Let's go across to Lata now to understand the impact of this decision. Lata, tell us, what is your take on this particular order?
Well, for the past 2 or 3 years, government, RBI, SEBI have all been wanting this step that large corporates should borrow from the bond market. One, because it eases pressure on the banks, it gives them competition, and the bond markets also develop. Finally, SEBI fired the firm salvo that banks get up until April 1st, 2019, and thereafter 25% of their borrowings should be through the bond market. The filters are, it should be a large borrowing, that is over 100 crore in terms of loans, and they must be AA rated and above companies. So the better run companies have to show the way, and eventually, of course, it will be brought down to other companies as well. SEBI clearly is meaning this to be experimental, because for the first 2 years, companies will not be punished if they disobey. The rule will be comply or explain. So if you don't comply, you have to give SEBI a reason why you did not comply. Now, what experts tell us in the bond market is that, we should not look at bond markets as a panacea for all ills. Yes, if you go to the banks get into NPA problems and there is an opaqueness. You don't know how well the corporate has been rated. It is not as if the bond market solves all those problems. A lot of corporate bond paper cannot be valued at all because they're not traded. Out of some 18,000 paper that is out there, only 3,000 or 4,000 are traded, which is 20%. And even where they are traded, it is traded once in a way. So you don't have a price to value it. That's why things like IL&FS happen in the bond markets. And therefore, the market experts would say that it is good that SEBI is feeling the way. We must use these 2 years to put in good rules and to actually increase the intensity of trading so that when you want to value, the market at least gives you a price. So there's a lot of work to do. This is just the first step.
All right, and that's not all. SEBI has also made it cheaper to invest in mutual funds. And towards that end, the market regulator has capped the total expense ratio of active funds at 2%. Though the reform is aimed at attracting more investors to the mutual fund markets, some companies believe that it could have an adverse impact on their business.
The point that you cannot pay upfront commissions means that even if there was any scope to influence someone by way of commissions, then I think that is out of the window. And I think in the investor interests, the AMC's interests, and the advisor or distributor's interests, everything gets aligned because, if you are in the fund and the fund is performing, then everybody gets their due fees. My sense is that the gross inflow would decline, and at the same time, the rotation or churn of funds, someone moving in and moving out, that also would decline. So I think on the inflows, outflows across the board, I think you will see slightly lower volumes than what you have been seeing in the past.
Okay, so important to track that story because remember, AMCs will be in focus. Brokerages like CLSA write that lowering of the total expense ratio could lead to 15 to 25 basis point reduction in equity fees. So those stocks will definitely be in focus today. But Amazon-backed Samara Capital is likely to announce the acquisition of Aditya Birla's more retail chain today. Details on that exclusive when we return.